I'm also happy that it seems like now 2000 is not the question anymore. I mean, we have stayed over 2000 for a long time, very stable. So not really coming, because we had this period that we were over 2000 and then down again and then over and then down. And now we have actually stayed over 2000 for a long time. And for me, I think 2100, if we can stay there over a time, then we really get the speed up and we will never look back again. If we get a 20% gold return this year, I think it's very realistic in dollars. And then we get the gold to silver ratio go from 85 to 70. We would see a silver price on 35.
In a recent interview, EricStrand, the Swedish fund manager and founder of AuAg funds, shares insights into his winning strategies for 2024. Strand emphasizes the importance of the gold price staying around $2,100, suggesting that this stability could lead to an acceleration and sustained positive momentum. However, the current scenario presents challenges, with the gold price hovering near $2,017 and facing potential further declines toward the psychological support level of $2,000. The critical 50-day SSMA support at $2,021 is being tested, and a failure to defend it could trigger a renewed sell-off towards the $2,000 mark. Strand acknowledges that spikes in gold prices are typically short-lived, providing only temporary protection for portfolios before experiencing declines. He attributes the continuous increase in debt and money creation, particularly with substantial deficits in the U.S., to the fundamental support for gold. The U.S. national debt has become a significant concern among policymakers, surpassing $34 trillion and setting a new record. The country has consistently operated with budget deficits over the past 5 decades, leading to borrowing and contributing to the national debt. According to EricStrand, it becomes an interesting scenario when the gold-to-silver ratio is high, like at 85, and it decreases to 70. He suggests that a 20% gold return this year appears realistic. If the ratio drops from 85 to 70, it could lead to a silver price of $35, resulting in a substantial 48% return. The gold-silver ratio is 86, about 11% higher than the lowest point in 2023. Silver is poised for a price increase when the ratio is at 80 or higher, because gold is relatively more expensive. Join us as we delve into insights shared by EricStrand. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Spikes are never sustainable because they always come down again. So it's short-term protection in a portfolio, yes, for the total portfolio, but I mean, can come back to where they were. So that doesn't really help gold prices in the long run. I mean, gold prices are a mirror of the money creation and debt creation in the financial system. And that's a long-term trend that I probably won't disappear during our lives, because they just create more debt and more money. We see the debt in the US just such big deficits. So there are so many strong fundamentals for gold, and especially when we get a softer dollar, making gold cheaper for investors. I think we get a lot of buying power there, and that would take the price up. And of course, we have a very low sentiment in the market for gold or gold miners. And when that changes, I mean, you open all the gates. People start to hunt the price, and I think that will come later because we have been in a depressed market in some ways. So it will take time. And of course, that's good for any investor that want to accumulate. It's an opportunity. I think we're like, this is an opportunity situation. I mean, in the silver, when the silver price is the gold to silver ratio is so high, and we have to see that come down from anything like 85. We have to see it come 70, and then I think it gets really, really interesting, because if we get a 20% gold return this year, I think it's very realistic in dollars, and then we get the gold to silver ratio go from 85 to 70. We would see a silver price on 35, and that would be a 48% return. Then it would become more interesting to see how these miners, how much, I mean, when you see how much silver do they mine, it's on revenue. And when the gold to silver ratio is very high, I mean, it doesn't look like they mine so much silver, because the revenue is not so high because the price is so low on silver. So when the prices come up in silver and starts to really go, I think, I mean, the revenue from silver will be higher as a percentage of these companies, and it will get more interesting, of course, for them to try to mine more, find more silver. But and I think silver will be really explosive. Unique matter that it's both. I mean, it's the one that is both, and I think that's a very strong for an investor, because when you get a physical shortage for the industry, and you use silver in like everything, every camera, every computer, every car, sun cells, everywhere you need silver. But it's so little silver, so the price is inelastic. So the car companies, they will buy the silver for whatever price, because it will not change the price of the end product. So for them, it doesn't really matter if the price is 25 or 100, it doesn't really change, and they need it for the car. It's only 40 grams or 50 grams in the car, but they need it. And we get this physical shortage, and we're really looking that there are no reserves anymore that can be bought, that is not owned by other investors, and they will not sell now. When we have had this managed price to a too low price, you actually create this situation, because nobody has the real incentives to try to mine enough silver. So I think something big will happen in silver. I've been thinking that for a long time, of course, but I mean, it gets closer by every day. That's a mathematical fact. And if you look at the numbers, how tight it is, how they have to ship silver in and out just to make it work. And when the rumors get that we have not premiums on retail buying silver coins, I mean, that solves itself by these premiums. But in the industry, never happening in gold. And of course, on the other side, if you have copper, it's only industrial. So I think silver is the perfect
the perfect metal.
According to EricStrand, the Federal Reserve might consider lowering rates to control inflation. However, Strand expresses skepticism about this being the ultimate reason. The latest data showed that in the 12 months through December, U.S. consumer prices edged 3.4% higher, after increasing 3.1% in November, tempering expectations of an interest rate cut in March. However, the pace of price rises has slowed from a peak of 9.1% in June 2022. The Fed targets an inflation rate of 2%. The U.S. central bank's policy rate currently stands in the 5.25% to 5.50% range after a 525 basis points hike since March 2022. Rate cuts are seen coming as early as March. Strand observes a back-and-forth dynamic where the market reacts strongly to the Fed's statements, especially evident in the gold price reaching new highs during periods when the market believed in a policy shift. Let's get back to the interview.
Well, what is interesting that is like everybody wants to see lower rates, and we need lower rates probably in the system. But I mean, the reason for the lowering of the rates are different. As I said, the Fed, they think they will do it because they have controlled the inflation rate. But I don't think that will be the reason in the end. So as we have seen in history, there are no such things as soft landings really. And we have also seen that they normally lower rates much faster than they raise them. So, of course, the Fed, I mean, talk is cheap. So, of course, they want to say higher for longer or transitory. I mean, they want to use these words. Sometimes you're surprised that the market really believe them. And that's what we have seen in the gold price. When the market really believed in a pivot, the gold price was really flying, making new all-time highs. And, of course, then the Fed was out again saying, no, we will not. Became a headwind for gold. So it's this back and forth, but not really based in what is happening in the world, but more based on just on what they are saying from one point to another. I would rather say that they would have to give up on inflation. So they cannot keep what they really want, because first of all, the prices are elevated. I mean, to get the prices back where we had them 2 or 3 years ago or something similar like that, they would have to have a really high interest rates to get there, and we won't get there. So the prices will stay high even if the inflation rate is getting lower. But as you said, I think what is really driving inflation are strong forces that we cannot really change, and that is we have had production prices going down for 30-40 years, moving labor to the Asia East, and now we also see even the deglobalization. And these are very strong forces we also see a larger middle class in India, China, with more buying power, and of course, they will compete on the same things. So I think we will have inflation, and we will have to live with inflation. And on the other hand, the system wants inflation because they want us to consume. I mean, is it like 70% of the GDP in US is consumption? And if you don't have inflation, you don't get the buyers to buy now, and that's what you want. You want them to buy now because inflation is really like I wouldn't say funny because it's really a terrible thing, but it's something they want, and sometimes they say they want to make it lower or it's their target to have it at 2%, and so I think it's just I wouldn't say a game, but they talk a lot. I mean, things are happening and it's very unsecure, and you have to. That's why you get the deglobalization. You want to secure, like mining in critical metals. You have to mine them in Europe or in the US. That won't be cheaper, maybe safer, but it will become more expensive. So there are a lot of things that will make the case for strong or higher prices in the future, and instability in the world is very much such a thing, and we will see. I think we will see more of that, and terrifying, of course, to see how what is happening and what can happen. I mean, it's like also China, Taiwan. I mean, I hope nothing happens there, but if it is going to happen, I mean, there's a good. Now, when the US is so preoccupied, I don't know if there would be a better timing for China to move. So I think that's a little bit scary.
Global growth will likely slow this year, but a dovish tilt in the Federal Reserve's stance has raised hopes for the U.S. economy and brightened the outlook for riskier assets, according to big banks. This positive shift in the Fed's position has also improved the outlook for riskier assets. Despite these positive indicators for the U.S. economy, gold prices experienced a decline, reaching a more than 1-month low on Wednesday. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.